REITs. How do we handle REITs? Because REITs are really been hot for the last couple of years, and they're only getting hotter. And you guys are going to love this call, because when you come across somebody with a REIT, they are leaving their advisor, I guarantee you. After this call, if you run across somebody with a REIT, they are leaving their advisor, chop, chop. So first thing I want to emphasize, though, is I'm not going to point out that REITs are bad investments. Is there any bad investment out there? No, guys. Well, there are bad investments out there that are illegal, but are there any regulated legal investments that are bad investments, guys? They might be bad for certain people, but as a whole, can we classify any regulated legal investment as bad? No, because all investments are what? Good and bad. Every investment has an advantage and a disadvantage. But the problem is, what do most advisors do? See these? We show advantages here and disadvantages. How much time do they spend on the advantages, guys? How much time does a typical advisor in a 1-hour presentation spend on the advantages? So let me see some answers to that. 95%, I think you're being conservative there, Bill. 95 seconds, Dale, that's what I would say. Seconds, 0. I'd agree with Glenn, 0. So the problem with REITs is not that there's a problem with REITs. The problem with REITs is the advisors are not disclosing any of the disadvantages, and that's what we're going to talk about today. So see this company here, Securities Litigation and Consulting Group? If you've sold a REIT, you do not want to see this name. If you sold a REIT, you do not want to see this name, because you're just about to lose months and months of your time, tens of thousands of dollars, and possibly your practice if you run across these guys and you've sold a REIT. They've come out with this primer on non-traded REITs and other alternative real estate investments. So we're going to go through this, and you can find this right online, or we can give you a link to it. This destroys, guys, if you've sold REITs, the last thing you want is this report put into the hands of your customer, because you are just about to be sued. If you sold a non-traded REIT, you are about to be sued if somebody puts this paper into your client's hand. Now, do we put this paper into our client's hands, guys? So let's see that. Do we put this paper into our client's hands? What do you think? No, Bill. Does everybody agree with Bill? Guys, we don't use these. The only person they believe is who? Themselves. But this is a great primer for you to have on to be familiar with if you're running into a lot of clients with REITs. So as you go through this, the first thing they come across is, do retail investors really need more real estate exposure? Because think about this, guys. Our clients already own a home, and what percentage, guys, let's see some answers to this. What percentage of their portfolio is their home already? I mean, we look at their assets, what percentage of their assets are in their home? High or low? Where's most people's money? At least 50%, yeah. So do retail investors really need more real estate exposure? You see down the bottom, empirical literature shows that real estate housing stocks are generally unattractive, except for investors seeking high-risk return portfolios. So what's that saying? Sure, if you want a high-risk, high-return portfolio, but how are REITs sold? As high-risk, high-return portfolios? How are REITs sold by advisors, guys? As high-risk, high-return portfolios, how is it sold? Safe, exactly, safe, and income. Not sold as a high-risk, high-return portfolio. And you see here, there's lots of ways you can be exposed to real estate. You can have home builder stock, open-end funds, closed-end funds, unit investment trusts, exchange-traded funds, traded REITs, non-traded REITs, private REITs, TICs. Now, of these guys, let's see some answers. What do you think pays the highest commission of all these? What do you think pays the highest commission of all these? By far. Which one pays the highest? And I know the people who sell them know. Actually, it's non-traded REITs. Why? So guess why everybody sells non-traded REITs? Because they pay the highest commission. And are they liquid? No. They're not liquid at all. That's why they can pay such a high commission. So you're going to see in here. So this paper goes through all the different ways you can invest: open-ended, closed-ended funds, real estate stock, ETFs, non-traded REITs. But when they get to the non-traded REITs, so they're saying all these other ways, hey, go ahead and expose yourself to real estate if you want high risk, high return exposure to real or exposure in your portfolio, and he gives all the reasons all the other investments are okay. There's only one investment he's saying is not okay, and that is non-traded REITs. And the reason non-traded REITs are not okay is you're going to see they have tons of problems. Number one, non-traded REITs suffer from conflicts of interest, illiquidity, and unreliable reported values. So despite widespread collapse in the commercial real estate market, asset values of non-traded REITs continue to attract new investment. Why? Because the lure of high regular distributions styled as dividends and apparent low price volatility made non-traded REITs seem like safe and reliable, but they're not. Because are they getting, as the distributions are getting simply interest? We're going to talk about that. And is there low price volatility? We're going to talk about that. So the way they're being sold as regular distributions, good interest rates, good income, and safe, low price volatility is what? Is that true or is it bogus, the way they're being sold? Is it regular income they're getting? Is it low price volatility? No, they're hiding both of these things. So any investment that has to hide those things that they're promoting is what kind of investment? And that's why if you sold REITs, non-traded REITs, you could be in some trouble. So indeed, much of the growth of non-traded REIT investments has come from retirement and other conservative retail investors. The very people that should not be investing in them are investing in them. Recently, non-traded REITs have come under increased scrutiny by FINRA and the SEC for allegedly misleading investors about the value of their investments. Some non-traded REITs have paid a substantial portion of their dividends out of proceeds from issuing debt rather than from the earnings of the real estate. So they actually are borrowing more money to actually pay the dividends to make the dividend look bigger than it is, or from the sale of property. So while non-traded REITs claim to offer retail investors access to professional managers and real estate assets typically only available to institutional managers or high net worth individuals, they may in fact use their relative lack of transparency to deceive these relatively unsophisticated customers. Guys, I want to see some answers to this. How many clients who bought REITs really understand, even to a small degree, what they bought? I mean, I'll take it one step further. How many, you'll see today as I go through this, and I've shown this to now 3 different guys that have sold tons of REITs. Guess of those 3 guys, and these are sophisticated, well, they're very successful investment advisors. Guess how many of them understood this? No, because they were selling it the same way that we're finding this problem. They're selling the interest and that it's safe. When I went through these things, they had no clue that these things were happening inside of non-traded REITs that I'm about to show you. So the first thing, A, non-traded REITs are rife with conflicts of interest and attendant high fees. The commonality of key individuals and entities in multiple aspects of the REIT's business can lead to substantial conflicts of interest. Basically what they're saying there is there's many layers to a REIT. And virtually with almost any REIT, all those layers are actually owned by the same people with different company names. Because the regulations state that you cannot, the same entity can't do all of the different jobs that are required for a REIT. And the reason they do say that is so there's no conflict of interest. So guess how companies have got around that? They just created new entities that are still owned by the same. So they've just skirted the whole regulation of not having one company have be responsible for all the different things that have to occur. And you'll see here in a few minutes how bad that can, bad things that can happen with that. See, there are substantial opportunities for a REIT sponsor, perhaps through its affiliates, to, number one, use a credit line of one REIT to finance the operation dividends of another. That's where you're seeing these people thinking they're getting high interest rates, but all they're doing is taking out more and more loans to pay for those interest rates. Number two, artificially increase the asset turnover to maximize compensation, because as they sell properties to one another, they pay commissions again and again and again inside the REIT, which the customers never see. It's only the people who operate the REIT see. Number three, allocate a substantial portion of over and underperforming assets to a single REIT at the expense and favor of others. And then four, use his or her managerial knowledge or influence in a REIT to benefit other unrelated investments. So a lot of these people who own REITs own other things outside the REITs, which they can then pump money into from the REIT because it's very non-transparent and the investors don't have that, can't leave if it's performing poorly. Do you get that? Then here we go. The dealer managers often paid excessive commissions for selling their shares, as high as 10% of the share price. These rates are substantially higher than on mutual funds and ETFs, which have commission levels of typically 2 to 3%. And that's not the only fee. We're going to see that these things are rife with fees. The advisor-sponsored dealer managers are often controlled by the same management team. That's what I was just talking about. Therefore, while the North American Securities Administration Association has published guidelines restricting the ability of the sponsor and advisor to sell properties, to offer financing to jointly invest in the REITs, these guidelines are effectively sidestepped by the creation of several special purpose entities. So this one REIT, for example, the advisor is Behringer, the sponsor is Behringer, the dealer is Behringer, but they're all Harvard Opportunities, Harvard Holdings, Behringer Securities, BHO Partners is Behringer, 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 Behringer. So virtually all the North American Securities Administration Association says they're not supposed to be, the advisor, sponsor, dealer, limited partner, operating partner, property manager, and affiliate are all supposed to be different entities. But essentially, they're all the same entity. They're all the same entity. So what's the problem with that? Well, advisors and dealers can be paid up to 15% of proceeds raised in an initial offering for organizational and offering expenses. 15%, guys, that means if somebody invests $100, 15% goes right down the tubes immediately. And then every year thereafter, property managers receive 2 to 3% of the gross income from properties they manage. Affiliates may receive a commission up to 3%. So now we're up to 18% initial. Then we've got another 2 or 3 happening every single year. 20% right down the tubes in the first year, and then 2 to 3% every single year thereafter. External advisors receive acquisition and asset management fees as large as 6%. So now we're up to close to 26% initially. That's guys. If you invest in an initial REIT, that means you've lost a quarter of your money right up front. And it all went to fees. So do you see why? Do you see why these REITs are popping up all over and they're paying such high commissions? Because they're netting 20% immediately right off the top. So look at all these fees right here. Example of non-traded fees. Selling commission for the dealer, 7%. Dealer management fee, 2 to 3%. That's yearly. Market allowance, 1 to 3%. Organizational expenses, a max of 15%. Acquisition fees, max of 6%. Acquisition expense reimbursement, 4%. Asset management fee, 4%. Property management fee, 4%. Oversight fee, 1%. Construction fee, 4 to 6%. Operation expenses, 2%, 1%, 2%. Guys, do you get why so few people? Guys, if you've ever sold a REIT, how many of you? I want some people to answer this. If you've ever sold a REIT, and I unfortunately did in the 90s. Guess how many of my clients saw clear to any positive positive return on their principal? And this is when property was skyrocketing in the 90s. Real estate was skyrocketing. Guess how many of my clients at the maturity of that REIT ever saw the same amount of money that they put in to be taken out? You're right, Bill and Bill. None. Zero. And this is a time when property was skyrocketing. It's because of all these fees, it's impossible. So most of my clients took a loss on their REITs. Most. How about all of my clients took a loss on their REITs? But because it's so long, it's 10 years holding period or whatever, we hope that doesn't happen. And we go ahead and make our 7% now, hoping that does. Guys, foolish, 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 especially nowadays with the internet and with TV, these guys advertising on TV to go after advisors to sell these things. Here's the next thing. That's only point A. Point B, non-traded REITs are illiquid and have unreliable values. Non-traded REITs are illiquid investments. No public secondary market exists for shares of non-traded REITs. Investors are effectively unable to sell their shares even if the value of the REIT or the underlying asset is significantly decreases. In order to mask this illiquidity and justify the reported valuations, many non-traded REITs offer grossly imbalanced repurchase programs through which investors can sell their shares to other investors or back to the brokers at a significantly lower price. For those of you that have seen this, guys, the clients have to take a huge bath if they ever try to get rid of these. And it gets worse. If there are large numbers of shareholders trying to sell, non-traded REITs management reserves the right to limit the number of shares that can be sold or discontinue the program altogether. So they can say at any time, we're not offering. And I've seen REITs do this because enough clients have realized it was a crappy investment. They go ahead and take a 15% or a 20% discount to get out of it, and they're not even allowed to do that. So how much of your money, of your client's retirement money, should be in something like this, guys? How much of your client's retirement money should be in something? I mean, annuities get hammered for a 7 or a 10% this is this is horrible. Do you get it? And yet, here's the imbalance. FINRA and all those allow people to sell this, but they get their panties in a bunch about annuities in the holding period. At least with annuity, can you always dump an annuity? And what's the worst penalty you can get on an annuity when you dump it? And these are way worse. So, do you get the problems with this? And do you get, if you sold a REIT, that you better in the heck hope that your client doesn't get their hands on this paper, because they may very well contact this agency, and you very well could be in a world of hurt. But now, how do we deal with this? So I'm going to have this script is on the website under REITs, and I'm going to go through it with Jeff. So remember, with anything that we're not going to point out that REITs are bad or good, because REITs aren't bad or good. Though I would venture to guess that they're less good than they are bad. But the whole point is we're not going to attack the investment. What's the purpose, guys? Let's see some answers to this. What is the purpose of the disclosure meeting when we're going through the client's portfolio? What's the purpose of the disclosure meeting when we go through the client's portfolio? Let's see some answers to this. Get them mad? Nope. That's partly right, Matthew, but not kill the broker. That's what Gene. That's what I'm looking for. Kill the broker. Because here's Matt. Because a lot of people give us that answer, get mad. Jeff, what's wrong if we just get the broker mad, or get the client mad at the broker?
Well, the problem with getting the client mad just mad about REITs is they may dump the REIT, but they won't dump the advisor. So if they're unhappy with the investment, they may change investments, but they may not change guys, and they won't change guys because it's a hassle and it's a confrontation. If there's really no reason to. I mean, everybody has good and bad investments. So if all you're saying is this is a bad investment, you should get out of it, they'll get out of it, but they won't move to you.
So our job is to show that the guy has character flaws. The guy hid things from you so he could make money. See, if they're mad, they can change that and then not be mad anymore. They can get mad at their guy, and the guy says, I'm sorry, I'll never do that again. But if they find out the guy hid things from them on purpose so he could make a commission, do they ever want to work with that guy again? If he purposely hid things from them so he could make a commission, do they ever want to work with that guy again? No. So our job here is to make them realize not that REITs are bad, not that REITs are good, but that the guy withheld information from them for one purpose and one purpose only, and that was to take advantage of them. Screw them. Okay? But we always start out by talking about something why what they did was good. So if it's a variable annuity, we talk about why variable annuities are good. If it's a power of attorney, we talk about power of attorneys are good. And we're talking about REITs here, so the first thing we're talking about is why REITs are good. Okay? So Jeff's going to be my client. So Jeff, I mean, I see that you have a REIT, and these are good income investments, aren't they?
Yeah, I think they're pretty good.
I mean, is that why you bought this, is for income?
Yeah, I mean, it pays that high interest rate, so yeah, that's the primary reason we got it.
I mean, it really does pay a nice dividend, doesn't it?
Yeah, it does.
And why is income so important in today's world?
Well, especially I mean, you just can't find things that pay that kind of interest. And for us, we're retired, so having that extra income helps.
Well, you bring up there's not a lot of places paying that kind of interest. I mean, it's paying 5-6 times higher than a CD or anything, so you're absolutely right. And also, I mean, it's not a bad way to diversify, is it?
No, I think it's a pretty good way.
Yeah, and why is diversification important?
Well, we just want to make sure that, we don't have all our eggs in one basket, that, we're, not relying on any one thing.
Yeah, I mean, those are the main reasons people buy REITs, is that you don't want all your eggs in one basket and you want that income. I mean, is there can you think of any other reasons, or are those mostly the reasons that this REITs made sense for you?
No, this is pretty much the reason we got into it.
Yeah. I mean, so these are really great reasons I mean, we all want more income and we all need diversification, so that makes sense. I guess the only downside is that, the liquidity is not so great. I mean, can you sell it today if you just wanted to?
I think you'd have to take a pretty high penalty or something if you tried to get out today or right away.
Yeah, and I think they only allow you like 2 weeks a year to even get out, and I think you're right. There is a huge penalty. So it's not the most liquid thing in the world, but as long as it's giving you good income and diversification, who needs liquidity, right?
Right.
Right. So, I mean, again, if you need income, you need diversification, then maybe the liquidity is okay. What do you think?
Yeah, I mean, it's not all our money. We just want to make sure that we're getting this good dividend if we can.
Yeah. Yeah, so that makes total sense. And if you think about it, I mean, if it's a safe investments usually are a little less liquid, aren't they? I mean, think about bonds and CDs. What do they always have on them?
Well, like a maturity date, you can't, it doesn't mature for a while.
Yeah. So they have a maturity date that you have to hold, and if you take it out earlier, you get hit with a penalty. I mean, the penalty's not nearly as high as with the REIT, but they kind of work the same way, don't they?
Right.
But with risky investments like stocks that go up and down and mutual funds go up and down, how quickly can you sell them if you want?
You should be able to sell them any time.
Right, because with risky investments, why is it so important that you be able to sell those when you want to?
Well, in case, it goes down too far, you just want to make sure you can get out.
Yeah. So I'm going to step out of role play here, guys. So what's the point I'm making here, guys? They said they wanted income. They said they wanted diversification, and they said they wanted a safe investment. What am I about to show them, guys? So they said they want income, they want diversification, and they want a safe investment. What do you think I'm about to show them in the remaining of the script? Dale's asking, where's the REIT script? The REIT script is under the disclosure meeting. So if you look under the disclosure meeting on the website, that's where it is.
So if you look under the disclosure meeting on the website and you go to fees, and you click on fees, there'll be scripts for VA fees, scripts for B and C shares, and the script for the REITs. Yep, and this video will also be placed under there on the next few days as well. So here's the thing. When I asked, hey, I said, hey, it's good for income, it's good for diversification, and it's good for safety. I mean, those are the things that you want. Now, when I asked you what I'm about to show here, I had some people say, hey, you're showing them that's going to show them an income rider on an index annuity is better. Guys, is the disclosure meeting about selling a product? No, it's not about selling a product. It's about what? Having them understand their guy screwed them. So I got lots of other answers here where it says why it's not any of those three things, and you're exactly right. So anytime I'm having them tell me how great something is, you know darn well I'm about to show them that all those great things that they thought they had, they don't have. So I'm about to show them that, yeah, income's great, but this isn't a good income. Hey, diversification is great, but this isn't diversified. Hey, safety is great, but this ain't safe. So you're exactly right. So I have them agree that those things are terrific, and then I say, well, but if you want those things, you went to the wrong place. So here we go. So can I ask you a question, Jeff? So REITs make a lot of sense because they have good income diversification. Now let's say you open the paper today and you see that there's a bank paying 8% on an 8% CD. What are you going to do? I'm going to go down there and check it out.
Duh, right? I mean, 8% on a CD?
Yep.
So you go down there, you check it out, and you ask, how can they possibly be paying such a high interest rate on something like that? I mean, wouldn't you ask that?
Yeah, I definitely ask. When
everybody else is paying 1 and that's paying 8, you're going to say, what's the catch here, right?
Right.
Yeah. So they explain to you, well, the 8% isn't just 8% interest. They're actually giving you 4% interest, and then 4% of it is a return of principal. Now, what does that mean is happening to your chunk of money as they're paying you that 8%?
Well, I'm not really getting that 8%. They're just paying me back my money.
Yeah. So should they be advertising it as 8%, or they should be advertising it as a 4%?
They should be advertising it as 4.
And if you found out, so let's say that, how angry would you be if you found out after the fact you just took them at their word it was 8%, and you get your first statement and you see your principal is down by 4%? How angry would you be?
I'd be really mad.
And what would you do with your money if they played that trick on you?
I'd take it out. I'd go to another bank.
Yeah, why? Because 4% is still a good rate of return, isn't it?
Yeah, but you're not dealing with people that are honest.
And what's the problem when you talk about your life savings and not dealing with people that are honest? What else are you worried about? Just this?
Well, we could lose everything. That they're not being honest about anything.
That's right. If they're just not being honest about this, you start to worry about they're not going to be honest about what?
About anything.
About anything. And the reason I bring this up is you're obviously going to be angry, but the reason I bring this up is that if you Google non-traded REITs and FINRA, or non-traded REITs and SEC, now do you know who FINRA and the SEC are?
Yeah, I mean, they're like regulatory agencies that watch over securities industry.
Yeah, that's exactly right. So if you Google non-traded REITs, which is what you have, and FINRA or SEC, guess what you're going to find out? They're all doing that. But the interest that they're paying is not interest. It's interest from the property, but it's also return of principal, or even worse, these REITs are going into debt to pay the interest. And what is it called when when you borrow more and more money to pay out the investors?
Like a Ponzi scheme.
A Ponzi scheme. And these companies are getting into huge. So just go ahead and Google and guess how many millions of stories you're going to find about that. You know where it says the number of stories that meets those match? That
Sure.
You might not. Yeah, millions. So that's the why I bring it up. Had you ever heard of that before, or were you told that the interest was interest? Were you told what was made the interest up?
No, I just assumed it was just straight interest.
Yeah, I mean, that's what I would assume. If somebody tells me something's interest, I assume it's what?
That it's interest.
Do I assume, like at the bank, that when they say 8% interest, that it's some of it's interest and some of it's return of principal, or even worse yet, they're going out and borrowing money to pay me that?
No.
Because if they're borrowing money to pay me that, what do I know at the end when it comes due what's going to happen?
They're not going to have the money to give it back to me.
Exactly. And so is that what we put the money in, is to just to pay it, to have it all paid out in interest, and then find out at the end we have less than we put in?
No.
I mean,
No.
if you'd heard about that before, what would you have done?
I wouldn't have got into it in the first place.
But then you have to be asking yourself, well, how could they possibly get away with not telling people that? I mean, but it's not hard. It's not hard because, you know, if you get a statement from your bank, how often?
Once a month.
Yeah. And how quickly would you then find out that you're getting a return of principal?
Well, within the first month.
Yeah, and can you pull that money out at that point?
Yeah, you can.
Yeah, but with the REIT,
Well, yeah,
how often do you get a statement from them?
about once a year.
And guess who makes up the statement? Guess who tells you what that property, that real estate is worth?
I'm sure the company, the REIT company.
Ah, so guess what they can say? Have you ever seen somebody put up their house for sale, and it's maybe everybody else in the neighborhood is selling it for $400,000, but they put it up for $500,000?
Yeah, I've seen that.
So in their mind, they think it's worth $500,000, but what's it really worth?
It's really worth $400,000.
So
That's what they're.
Go ahead.
Yeah, if that's what houses are selling for, that's all it's worth.
Yeah. So when you get your statement, and the people who are sold you this are allowed to put whatever they value the property at, guess what they're going to tell you the property's valued at?
Well,
The $400,000 or the $500,000 they wish it was valued at?
They're going to put the higher, the $500,000.
Yeah. See, with a bank, they can't do that because you're going to find out how quickly?
Well, within the first month, within 30 days.
And money is money. So can they just say, well, I think your $100,000 is worth $150,000, or is money money?
Money's money.
But with property, can people value that at whatever they want to value that at?
No, they can just say whatever they want when it's property.
Because you see that in your neighborhood, right?
Right.
And it's even worse when you get into commercial real estate. I mean, does that make sense to you?
Nope, that makes sense.
So CDs can't get away with that, but REITs can do that because you can't call them and ask for the value tomorrow. If you call them and ask them for the value tomorrow, they say, well, we don't tell you except yearly. And then on the yearly, they're going to tell you what is it worth.
Well, they're going to say it's worth more than it really is.
Yeah. And is that really what you signed up for?
No, not at all.
So, I mean, that's a concern with the income, but it's also a concern with liquidity, isn't it?
Oh, yeah.
So how transparent is it?
Not at all.
With an investment, when you look at that statement, it tells you what?
Exactly what's happened with that investment, whether it's gone up or down.
If you wanted to sell it that day, it would sell for what?
Whatever it says it's worth.
Whatever it says it's worth, but is that the case with the REIT?
No.
So when things are less transparent, what can happen behind that shaded wall?
Well, they can do things that you don't know about, that might not even be legal.
Yeah. But if you find out some things in the news, or you Google and find out some things, and you want to get rid of it, can you get rid of it?
No, I don't think we can. No, I think we can only do that quarterly, or I can't remember, periodically, but no, we can't.
No. And in retirement, how important is liquidity?
Well, it's very important.
It's very important, especially for investments that go what?
Well, especially if it's going to go down.
Especially if it's going to go down. So let's talk about that. Have you ever heard of real estate boom and bust?
Yep.
I mean, what's it talking about when real estates go boom or bust?
Well, a lot of times, there might be like a housing shortage, and then there'll be like a a lot of people who want to buy, so you get a lot of building. That's a boom. Or there might be like an oversupply of houses, and then, you know, prices go down. That's a bust.
Well, you've just described perfectly what a real estate boom and bust is. When there's a real estate shortage, everybody in the world comes out of the woodwork, want to become a wealthy real estate investor like a Donald Trump, right?
Right.
So do you think they build the exact amount of real estate that's needed, or do you think they go crazy and build way too much because everybody wants to get in on it?
No, I'm sure it's like a pendulum. They overshoot.
Yeah, so you see here, it goes from optimism to excitement to thrill to euphoria, and then when they overbuild, what happens?
Well, they come crashing back down to earth, I guess.
Right, well, think about it. Why does that happen? Well, first of all, if people overbuild...
Yeah, there's more houses than people.
In real estate, in investment in real estate or in commercial real estate, there's more lease space than people that want it. So then what do the companies have to do with that extra lease space?
We'll have to lower the prices.
So then what happens to income for people that have invested in it?
Goes down.
Because there's too much space, so that people that were paying $2,000 a month are now saying, I can get it for $1,500 a month, and what do the people that have the buildings have to do?
They have to lower it to $1,500. They have to match that.
Yep, and the funny thing with REITs, is it their money being invested or is it your money being invested?
No, it's mine.
So what do they do then? They go ahead and what? I mean, how painful is it for them to lower the lease rates?
Yeah, you're right. They don't care.
No, it's not their money, is it?
No.
They just tell you, hey, sorry, this is what happened. Now, but you're double whammied here. Because what happens to the value of a building when it's half empty and the lease rates have gone down?
Well, the value of the building goes down.
So now two things have gone down on your REIT. What are the two things that have gone down?
Well, your rents and the property value.
Yeah, so your income, because that's where the rents
Yep.
pay into your income, and then so now they've borrowed to pay you interest, and so they're in debt there, so your principal is down. And what's happened to the principal that's left when they want to sell it?
It's down.
It's
going to
down.
be worth less. Yeah.
So had you heard about these things? Had somebody gone through all of this with you before you?
No, nobody explained any of that.
We
were just told.
Yeah, go ahead.
Well, we were just told that it pays this good interest rate.
Yeah. And if it was really that simple, if it was really paying that kind of interest rate, then it would make sense. But is it just that simple?
No.
No, it's not that simple. I don't know. Did you watch the 60 Minutes TV show on the ghost cities of China?
I didn't see the program, but I've heard of them.
What are they talking about, these ghost cities?
They're these like cities that basically just sit empty.
So they have 135 cities with skyscrapers. They even have a mimic or a complete replica of Paris built out that is sitting empty. Now, the reason I bring that up is they're cruising for what? When they've got 135 cities that are ghost cities that looking at sky rises, and think about Chicago with not a single person living in Chicago. What is that setting up for their economy?
Well, it's going to be disaster. I mean,
we talked about real estate boom and bust. What have they just set up?
A bust.
Yeah. Now, you'd think that doesn't really pertain to us, but guess who's one of the top investors in U.S. real estate as well?
Probably the Chinese.
So when theirs bust, what's going to happen to ours?
It's going to bust too.
Because they're going to have to do what with their money?
They're going to have to get
Pull
it out.
Yep. So had you ever seen any of these things before? Had anybody ever shown you any things before?
No, we hadn't seen any of it.
I mean, if you had, what would you have done?
We wouldn't have invested in this to begin with.
No, I mean, is this the safe, income-producing investment that gives you diversification that you thought you were getting?
No, not at all.
Not at all. So, but let's say even now you still love real estate. Well, if you love real estate, Jeff, can I ask you a question? If you want to invest in real estate, would you want more or less diversification?
Well, we'd want more.
And why?
Well, because we want to make sure that if there's a problem with one real estate sector or area, we're not burned.
Yeah.
By having all our money there.
Yeah, I mean, do some parts of the country do better than others?
Yeah.
I mean, does sometimes maybe one type of real estate doing better than another type of real estate?
Yeah.
So more diversification is a good thing, just like you say.
Right.
How about if you invest in real estate, would you want more or less liquidity?
Oh, we'd want more.
Yeah, and what do we find out about your current liquidity?
We don't have any.
Yeah, exactly. More or less fees?
Less.
More or less transparency?
More.
And why?
Well, we need to know what's going on so we can make sure that, there's accountability.
Yeah. And especially with an illiquid investment, how much more liquidity do you need with an illiquid investment?
Well, we need a lot more transparency.
A lot more. And then with real estate, I mean, can real estate be tricky?
Yeah, it can be.
So if you're investing in real estate, would you want a real estate expert that had no vested interest in whether you bought a piece of property or not to help you find the best deal and, more importantly, to avoid the shady ones?
Yeah, no, we'd want somebody who was unbiased.
And why would that be helpful? Because I agree with you.
Well, they're just going to be honest. I mean, they're just going to tell us the facts.
Yeah, because they don't care what kind of real estate you buy. They're just telling you the facts.
Right.
And that especially for something as illiquid as this is that more or less important?
No, you need to know it's more important.
And especially when we can find out that we can get trapped into something that said is paying income, but is it truly paying income, or is it paying some income and a lot of debt and payback of principal?
No, it sounds like it's debt and payback of principal.
And the reason I bring this up is, hey, I'm not saying real estate is a good or bad idea, but if you're investing in real estate, you want all these things, right?
Right.
Do you have any of these things with your current REIT?
No, we don't.
See, and here's the sad thing. You could have gotten all of that if you just invested in a no-load REIT mutual fund or an exchange-traded fund that deals with REITs. What they do is they go out and buy a whole bunch of REITs instead of one. So if they buy a whole bunch of REITs instead of one, what does that give you?
More diversification.
Which is a good thing or a bad thing?
No, that's a good thing.
Has more liquidity. If it was a no-load fund or an ETF, guess how quickly you can get rid of that?
Probably whenever you want.
So if you see that China is having problems and you're afraid that all the investors are going to yank out, what could you do?
Sell my shares.
If you're reading the Wall Street Journal or you're Googling something, you find out your REIT is doing funny business, you could do what?
Get out of it.
Yeah, I mean, is that a good thing or a bad thing?
That's important.
That's important. Would you want more or less fees? Well, REITs and ETFs, they average about 0.15%, 0.15% in fees as compared to 2 to 3% for an ETF. I'm sorry, for a REIT. So what's better, 2 to 3% a year or 0.15%?
The 0.15.
0.15. By a little or a lot?
By a lot.
Yeah. More or less transparency. Well, with a REIT and an ETF, they're required to give you prospectuses so you can look at them at any particular time that you want. Their books are open.
Right.
So is that a good or a bad thing?
No, that's good.
Could you get caught with funny business if it's transparent?
No.
And here's the thing. With the no-load REITs mutual fund or an exchange-traded fund that deals with REITs, guess what they have to evaluate all the REITs and all the properties out there?
Well, hopefully they have real estate experts.
Because they know that you could sell at any time. So how careful if they know that you're locked in, how careful do they have to be?
I guess they don't have to be careful at all if you're locked in.
Well, do you guess? Because how careful do they have to be? If you're locked in,
yeah, they don't have to worry.
They don't have to worry. But if you can leave anytime you want, now how careful do they have to be?
They have to be very careful.
And if there's lots of different real estate REITs no-load REITs and exchange-traded fund REITs, they could change from one to another how quickly?
Whenever they want.
So they're constantly trying to find what? For their particular,
the best real estate.
Yeah, so now you've got someone, a real estate expert, and guess all they do all day long is evaluate what?
Just look at real estate.
And they're going to try to find the best ones because they know if they don't, you're going to sell their fund or you're going to sell their exchange-traded fund. So
right.
Here's the question. On a no-load REIT or an ETF, the fees are 0.15 versus 2 to 3. Also, I didn't even bring this up. With a REIT, there's over 20% in fees up front that you don't even see before you get your REIT. So right off the top, all the REIT managers have taken 20% off the top before you even get the value of the real estate. Now with a no-load fund or an exchange-traded fund, they make sure that, do you think they're going to buy any real estate where they're going to get hit with a 20% discount right up front?
No, I don't think so.
No, they're not going to. So here's the thing. If somebody's locked in, it's not transparent, they're taking 20% off the top, how much do you think they could pay somebody to sell that versus a no-load REIT that people could unload anytime they want, could sell anytime they wanted?
I'm sure they can pay him more.
A little more or a lot more?
A lot more.
If you're locked in for 10 years and you basically can't sell that for 10 years versus something you could buy today and sell tomorrow, how much more can they afford to pay that guy who sold it?
A lot more.
A lot more. I mean, had you ever seen this before?
No, we hadn't seen anything like this before.
Were you given the choice of either buying a non-traded REIT or one of these?
No, they just showed us the one we have.
I mean, what would you have done if you were showing the both of them? If you wanted to be in real estate, which one would you have chosen?
We would have chosen the exchange traded fund or the mutual fund.
Do you think anybody in the world out there showing these two things would have done anything different than what you would have done?
I don't think so, no.
I know of no reason. So why do you think this wasn't shown to you?
Well, I'm sure he makes more money, so he wanted us to buy the thing that pays him the most.
And is that what you are looking for in a financial professional?
No, not at all.
So guys, there's REITs. So after you go through that with the client, how many people are going to love their guy for selling them a REIT? That guy is done. That guy is history. That guy is in big doo-doo with that client. So how many of you knew this about, I mean, how many of you got a true, I want to see some answers to this, a true education on how non-traded REITs work? A true education of why they're one of the worst investments a client can invest in. And I've said there's no good or bad investment. But guys, if you want to be in real estate, should you be in a non-traded REIT or should you be in a no-load fund REIT or a exchange-traded REIT? Because here's the thing, guys. They're going to get way more diversification. Because you're going to buy lots of real estate. You're going to buy lots of REITs, not just one. They're going to get way more liquidity. They're going to get way, I mean, we're not talking a little bit less fees. We're talking 10 times less fees. 10 times more transparency. 10 times more diversification. And I'm not exaggerating when I say 10 times. I'm probably being conservative. 10 times more liquidity. 10 times more non-vested advice. So there's only one reason people are selling non-traded REITs, and what's that, guys? Is it for the client's benefit? Because the client gets all these benefits and all the benefits a non-traded REIT gives them, plus all these benefits. So why are people selling non-traded REITs? There's only one reason. Exactly. I agree with you, Gene. A self-serving SOB. Because, guys, if you're selling, and here's the sad thing, if you're selling REITs that are no liquidity to your client, my gosh, shouldn't you know these things? How much more research should you do for your client if you're locking their money up forever, which is essentially what you're doing with a REIT? You better have exhausted all due diligence if you're locking your client's monies up. But they're not doing it. And they're not doing it because they're blinded by commission. So do you see how having this conversation with a client is going to change their idea about REITs? Sure, but is that what we're after? No. What we're having them do is change their perception of their advisors that SOB, as Gene so nicely put, is put us in this thing that is one of the most. I mean, guys, if they really thought real estate was the place to be, how much better would they be in a no-load fund REIT or an exchange-traded fund REIT? I mean, unbelievably a much better place. And they just don't show it because they won't make a 7% commission or an 8% commission on a no-load fund or an exchange-traded fund that's invested in REITs. Okay? So, guys, I hope